Welcome to Alternative Wealth, where we explore traditional and alternative investing, retirement, and personal finance concepts. I'm your host, Ryan Kolden. Join us as we talk about the strategies and tactics that can help you make better financial decisions.
Ryan Kolden is an investment advisor representative of RPG Family Wealth Advisory. Kolden Wealth is a DBA of RPG Family Wealth Advisory. The opinions expressed by the host and/or guests in this podcast do not necessarily reflect the opinions of Kolden Wealth or RPG Family Wealth Advisory. No information on this podcast should be construed as investment, legal, tax, or financial advice.
Today on the show, we have Van Carlson. Van is the founder and CEO of SRA AB Admin and has over 25 years of experience within the risk management industry. With a steadfast commitment to empowering trusted advisors and entrepreneurs through innovative risk solutions, Carlson has been a guest on more than 75 podcasts in a myriad of industries and has presented at conferences across the country. Carlson has also spearheaded SRA to new heights, earning a spot in the Inc. 5000, among other prestigious awards. Prior to founding SRA, Van ran his own property and casualty firm for 15 years and was awarded the President's Council and other top-performing achievements during his tenure as a P&C agent. In 2008, he also saw the Great Recession hit his commercial business clients hard, and just like them, he was also affected by the sharp downturn in the economy. During this time, he realized that there must be a better way to manage risk overall. From that desire to improve business operations for both himself and his clients, along with his extensive background in insurance, risk management, and finance, a mission to educate others about 831B plans began and continues. Van, great to have you on the show and welcome.
Yeah, thank you, Ryan. I look forward to having our conversation today. So thanks for having me on your show.
Of course. So today we're going to do a deep dive into alternative risk mitigation strategy called an 831B plan, which in my personal opinion is an incredibly innovative and tax-efficient method for business owners to not only strengthen, but protect their businesses from risk. But before we do that, I'm interested, Van, to hear about your background and how you ended up becoming a risk manager.
Yeah, by accident. Never sought out to be in the insurance business, honestly. I was heading down the world of corporate America, and we're headquartered in Idaho. It's a great state to live, and in order to move up the ladder of corporate America, you got to be willing to move every 3 to 4 years to, and I just chose it early on in my stage. I had an early I was young when I first started having my kids, and I realized I didn't want to sell my soul to the corporation. If I'm gonna work 70, 80 hours for a corporation, why not work for myself? Mm-hmm. And that's literally how I started. I grew my insurance agency from scratch and just kept that mindset, honestly. Nothing's easy. Everything's a grind. There are no straight lines, all of those things. And you got to, unfortunately, keep getting reminded of those things. So, along came 2008. And to your point earlier, thanks for that introduction, by the way, it just became earth shattering to me. Business owners, the entrepreneurs, the risk takers, they knew one thing really in their quiver of arrows is buy more equipment and we'll take the accelerated depreciation, and we just kept betting every year was going to be better than the previous year. And eventually the bottom falls out. And by the way, it's going to happen all the time, right? I mean, looking back to our history, it's just, the ebbs and flows of the economy. It is what it is. And mm-hmm. I witnessed a gentleman that had these plans in place leading up to 2008. And that's when I became a true believer. I saw him show up to the auctions. He was buying raw materials for 10 cents on the dollar. I mean, that's just what smart money does. That's what I would say. This is a smart money tool. When you're doing really well in business, how do you maximize those profits and maximize to the win? And, unfortunately we may go a couple of years of just losing or maintaining, but when we win, we got to really maximize the win because it gets into those peaks and valleys of businesses. If we can straighten that line out mm-hmm. through your industry, it will make you better, stronger, more effective business owner. And that's really what I saw coming out of 2008, the people that survived the Great Recession. And then it happened again in COVID. And we became more proof of concept after COVID, obviously.
I want to get back to that and dive into that a little bit deeper. But before we do that, I want to talk about the current state of the insurance market, which I think will set us up really nicely to go into why we're even talking about 831B plans in the first place. Can you just briefly discuss what is happening with price and coverages in the traditional markets, and how traditional risk transfer works and why business owners are starting to talk about B plans and how you fit think that kind of like fits that or fixes the problem?
Yeah, for sure. The code started in 1986, 831B. So a lot of your listeners might be hearing about it for the first time, but we're coming up on 40 years of that code being in existence. Very similar to the market space we're in today when it comes to traditional insurance. This is why Congress even passed the code was back in the mid 80s. And it really had to do with a lot with crop insurance and general liability. We were really picking up the litigious, we were becoming more of a litigious society through the 80s, shockingly enough, and it hasn't gone away. So from that standpoint, Congress has said, hey, we need to create an incentive. So given today's market, even going back to the 80s, in my going on 30 years in this business, I would have never, ever guessed at all where we're at today in the state. The state of the traditional insurance today is it's going to get worse before it's going to get better. And the timeline on these could be a decade, honestly. I think the burden of the business owner, the burden will continue to fall to the business owner. I think in traditional insurance is going to do still a lot of the heavy lifting when it comes to ensuring the tangible assets of your business. So I still think they're going to do a good job on your buildings, your commercial auto, your liabilities, and all those other things. But when we look at the complexities of risk today, it just keeps getting more complicated. And I think COVID kind of shown itself. We're even seeing issues with buildings today, though. We're seeing replacement going away on the endorsement policies, which is, again, shocking to me. But I get it. It's a 20-year-old building. They're just not willing to insure it for replacement today because what it costs to replace that building today relative to 20 years ago with inflation, with cost of materials and everything else, they're just not charging enough premium for that risk. And what insurance companies will continue to do to the consumers, and that's across the board between personal lines and commercial lines of insurance. The consumer can only pay so much in cost. Your threshold of pain on that comes quick. You're just not willing to pay as much premium, continue to pay more premium. I mean, most of our clients are looking at 30-40% increases since COVID, and it's going to go more, unfortunately, because we've not even priced in the LA fires yet and 25 losses. But what's going to happen is that they're going to keep, they're going to say, okay, here's our premium. The one way they can take rate increase without you necessarily filling it is adding exclusions. That is taking a rate increase. If they can lower their risk, they're going to have better underwriting and more predictable underwriting profits. And that's really what they live for. Insurance companies live and breathe for underwriting profit called surplus. This is where they get to put their names on the buildings. And this is the exciting part of the business. I used to think it was selling insurance was exciting. It's not until I talked to an executive at an insurance company and he said to me, he goes, you guys have a good time there, but it's kind of nice moving billions of dollars around in the back room that, it's the company's money. And I'm like, I can see that. Being a financial planner, I'm sure you can appreciate that, as I could imagine. But anyway, but that's really the state of the market is the burden will continue to fall to the commercial, the business owners. They're going to be paying more in premium, but getting less in coverage. And that's the foreseeable future, unfortunately.
And so that leads us nicely into 831. Business owner doesn't want to pay those premiums. They're inherently self-insuring or taking on those risks themselves. Can you explain from a high level view what an 831B plan is and how it's structured and how it interacts with a client's operating company?
Yeah. So getting back to that burden of self-insuring risk, and this is really why Congress even, back in the mid 80s, farmers were self-insuring crop insurance. Now it's fully subsidized, but even a lot of the farmers are still self-insuring a lot of their own crop insurance. So Congress basically said, hey, we got to create an incentive. If the business owners are going to retain risk on their books, and we call that an unfunded liability, right? You have an unfunded liability on your balance sheet. Now, traditionally, if you can buy, if you have a mortgage, I got a mortgage on a building, I got to get insurance for that. I'm going to pay a premium for that and get a policy. I'm going to transfer that risk to the insurance carrier for fire, theft, vandalism, wind, hail, and all that good stuff. And in turn, I'm going to pay a premium for that and get a contract from them. And then there's going to be risk that you can't transfer. And then it becomes down to risk financing. So to make it pretty simple, Ryan, is if you have this unfunded liability on your books, how do you want to fund it? You want to fund it with after-tax money or pre-tax money? And if you want to use pre-tax money, then that's something we got to go do for you as an administrator. No different than the 401k administrator. We got to go help form that entity. In this case, we're going to form a C corp that's going to look and feel like an insurance company that's going to manage your risk. We as your administrator do that on your behalf. So our core competency as a business is really managing insurance companies and admitting them at SRA. We don't complicate the business owner's life at all, but if you want to use pre-tax dollars to manage that risk, you need an administrator, and we're going to utilize the 831B tax code. If you don't want to use pre-tax dollars, then keep doing what you're doing today, because there's no difference. If something happens, you're just going to either pull it out of savings, your line of credit, your operating capital, and I call it unexpected expenses. And, and a lot of businesses run on thin margins. I think COVID's a good example. The reason why PPP and ERC and all the government programs that had to come out was those businesses' expenses. If they were forced to shut down, or simply their customers weren't coming into the door like they were at the volume they were doing so in the past, their capital is going to get eaten up. Those bills don't go away. The loan payments don't go away. The payroll doesn't go away. The power bill, all those expenses are still there. However, the revenue's not. And that's traditional business interruption. Traditional insurance policies will never cover those types of risk. And so there's a lot of, and that's one thing we do really well at, I think, because we are underwriters. We are risk managers first and foremost. We're not attorneys or CPAs, which most of our competitors are. We're risk management people. We'll hire the CPAs and attorneys and all that stuff, but we want to look at your risk. We want to assess your company. We want to, I'm very thankful for AI, because we have the ability now to pull through, load up clients' policies and really dig down as to what their exclusions are and what their first dollar loss is, which basically means deductible or co-insurances. What are they on the hook for before their insurance kicks in? And that's a huge unfunded liability on their books today. We see clients taking on much higher deductibles in the past. One way to offset the increase in premiums, but a lot of business owners are simply saying, "Hey, I'm not going to turn the insurance claim in if it's not, $50,000, $100,000 losses, because I don't want to take the risk of losing my insurance coverage." Because that's another part of the business right now. We're seeing a lot of people being canceled for having claims. So those are all just really things you got to balance, every year. And I will say this, and one of the things we at SRA like to say, we embolden business owners through innovation of risk management. And that's exactly what we've done. I think the best thing we can do for our clients is, when you're killing it, when you're winning, and when you're maximizing that win, is we're going to mitigate your tax liability, right? So I should mention, and sometimes I forget this, and this is probably the most important part, we're going to create a deduction at your operating company level. No different than what those business owners back in 2008 were doing with the 172 line item, with the accelerated depreciation. We're still going to create the deduction, but you're going to keep the money. You're going to retain the money for your rainy day r/war chest, whatever happens to be going on in your business, unfortunately, and at a time where you're going to need money you're going to need a war chest. And, we see it all the time, and so we talk to business owners about that, like, hey, how do you maximize those wins? We hope you win every year. I think, Ryan, and you've known us for a while now, I think the best thing a client can say to us as a risk manager is, "Van, I sleep better at night knowing I've done your program." And I think it's true. I've experienced it. I've seen it. I've had clients tell me that, taking a little bit off the top and parking it off to the side is not only good risk management, it's just simply good business. That's what big companies are doing. They've been doing it for decades. They're not afraid of the IRS. They're not afraid of those guys. What bothersome to me is the small to mid-market business owners that we work with, the risk takers, the innovators, the ones that go fight every day to turn a profit in their business. They're more susceptible to these types of risks than big businesses are. And yet their local CPAs don't know either about the code, which shocks me to this day. It's been on the books for almost 40 years, but I'll talk to a CPA today that will not have never heard of our tax code. And I'm just like, man, are you engaged? You're running you are working with a business owner that runs a $50 million a year operation, and you don't even know about this code? I don't know. And sometimes we can beat up the CPA because, you're not. I talk about CPAs, and CPAs are our greatest referral source, honestly. And for the right CPAs, we're a great tool for them. And I think that's all we are. We're certainly not a silver bullet, and we can get into some of the details of owning one of these, the complexities of the insurance company, the box and how it needs to operate, if you like. But That's really high level, is utilizing tax deferred dollars, still creating deduction at your operating company level, and creating an incentive for you to save money, not just spend money.
Absolutely. I have kind of 2 points on that. And one of the things that was most interesting to me about just captive insurance in general was when I first learned about this, almost every single Fortune 500 company is executing upon some form of self-insurance, usually large captive. But so that's the first thing. And the second thing is going back to building the war chest. And I'm interested to hear if you have any like good examples of when you've seen that, like with your plans. But let me give you an example of, I have a friend who he runs a lumberyard, a very large lumberyard, which is a commodities-based business. And one of the ways that they manage risk in their business is through hedging, commodities prices with futures and forward contracts on lumber. But even during the pandemic, they were not hedged properly because the price of lumber went up, I think, 3x. It was way more than they ever, planned for it, and they didn't have a good time. But I was just thinking, like, kind of reflecting on that, as if they would have had this massive reservoir of surplus capital, they would have been able to weather that storm, so to speak. So going back to you, do you have any good, like, favorite examples of when you've seen not necessarily the insurance component of the 831B plan, but just that excess surplus capital benefit a business owner?
Yeah, it's unfortunate, because I've been in risk management for such a long time. I've had those phone calls in the middle of the night, right? A fatality, an auto accident, or hey, my house is burned down. I mean, really tragic events. But then I've also dealt with business owners since '08 doing this business where, really unexpected things happen. To your client about the lumberyard. Now, typically you can't insure for business type risk because it's commodities and futures are, it's at the whim of the market and all that stuff and the economy and everything else. But what they experienced was true business interruption, right? I mean, with the COVID, I mean, that wasn't planned or expected, right? I mean, that's the difference when it comes to business risk, not to get too technical with that, but in their experience, yeah, absolutely. And it goes back to that gentleman in '08 that I witnessed had 7 or 8 of these, and he was a large manufacturer of RV, and I saw what he did, and that's just what smart money does. I mean, but going back to brand damage today, one of the things that we see a lot of is brand damages claims. I mean, it takes years to build a consumer confidence brand in your community, either statewide, nationally, or whatever you're trying to accomplish there with your brand. But it literally takes seconds to destroy, whether it's true or not. We live in this world of social media today. And there's been several incidences in the past where people said the wrong thing at the wrong time and was overheard, or somebody posted some stuff on Facebook that maybe compromised some of the HIPAA stuff when it comes to medical. I've had, doctors get, made local news on an incident and, hit their malpractice and they made the local news. And I've had people just do things they shouldn't have done and got caught up in the middle of it. And, and their brand is they were the brand. A lot of times we've seen people, and I call it the double negative when those things are happening. Okay, it's one thing for COVID to happen, like, for example, in Palisades right now in Southern California, we got clients down there that own businesses, but simply their customers aren't there anymore.
Mm-hmm.
Those subdivisions they were supporting was part of their business. Those clients aren't even there. So that's straight up business interruption. They didn't have a fire. That's a straight up business interruption. And so, how are they going to rebuild on that when your customers are gone? Or, we've had other instances where I get a lot of clients down in Southern California, Florida, because they'll shut down for 5 days and then the hurricane never hits.
Yeah.
Those bills just keep coming. That's a straight up business interruption. And the insurance industry is not going to cover that kind of stuff. It's not a direct loss. It's an indirect loss. So there's lots of incidences, Ryan, where we have that. And that's another thing I think we do a really good job with. I can't reiterate that enough, is we do a deep dive with the client when we sit down with them and go through there. They go through our underwriting process. I don't know if you've even been involved in those calls. But we do certainly a deep dive with the clients. And we want to, first off, listen to them, because if you've been in business long enough, something's happened. Either you thought it was covered, or you realized it wasn't going to be covered, or, hey, I turned it in and here's what happened to me. First and foremost is the client. And from there, we'll make recommendations based on your industry, what we've seen. And we say, hey, you're self-funding a lot of these things. Now, how do we fund for that? And by the way, it's not a silver bullet of this program. I mean, it's a long-term planning strategy to try to soften that a lot of those unfunded liabilities on your books. But we're putting a plan in place at least versus reacting to something after it happened. I think that's the biggest thing we can do, and that's really risk mitigation 101, right?
Right. I think the two biggest misconceptions that I've run into when talking about this with clients is the first one is people, they think, is this replacing my current coverages? And from what I understand is that you guys, first and foremost, as risk managers, are trying to find gaps in the client's coverages or areas where they're exposed to. And then the second kind of misconception that I see is, and I get this one, I think probably the most, but people say, hey, I'm not a manufacturer. Like I'm a doctor. Like how could I benefit from this type of plan? Could you briefly describe, Van, just some of like the major, so other than brand interruption, some other major coverages that people might say, oh, I never really thought that I had that type of risk or I could insure that?
Yeah. I want to make a point to you real quick. And we get the same, like, hey, can I replace my traditional insurance? Again, I think traditional insurance has done what they do pretty good. They're pretty competent with. I will say though, we're not here to increase or decrease the risk you currently have. We're here to recognize risk you're currently self-funding, self-insuring for, and how do we position that more effectively and efficiently through utilizing tax-deferred dollars. And so, but we do replace traditional insurance too. So if you got a big enough premiums and it makes sense, we can do those types of things. But when we talk about what you're describing is enterprise risk management, and it's it's been around for a long time. But again, to your point, Fortune 500 companies have been worried about their brand, their intellectual property, their supply chain risk, their contracts, and I mean, all of those things. That's enterprise risk management. And I would tell you that medical community today is certainly got a lot of issues with cyber issues. They collect a lot of data. I will tell you, we see a lot of that. Some clients will have their own standalone cyber policies, but they've excluded and limited so much in coverages today that the guidelines will be covered. Like if you're compromised, you got to do a credit watch for 2 years and everything like that on your patients and clients. When it comes to brand protection, when it comes to forensic, like what happened, who do I need to hire to come in? Those are all really limited dollar amounts. So that's something we'll build around. Employer liability practices today, we've seen a huge spike in employer liability practices. And that's really when an employee is suing the employer for hostile work environment or sexual harassment, anything that caused a hostile work environment. We've seen a big spike in that. What's been interesting to witness is the severity of the business interruption that causes to the business, especially if you're an owner. I mean, especially if you pride yourself on taking care of your employees, there's a mental drain of being sued by your employee. I've seen it. I've managed it through my clients over the years. However, since COVID, I will tell you, there's been a big spike on that. So we'll add business interruption under the employer liability practices. Another good, I mean, the key employee today, if you're a rainmaker, they might have short-term, long-term disability for themselves. But what about the business? If you're a surgeon and you make it rain in that surgical center, what happens when you get the skiing accident? What happens if you come down for a fatal illness? Not a fatal illness, but you got an illness where you're going to have to maybe have some therapy done or some radiation done, right? And these are all things that have happened. Huge business interruption to those businesses. And so again, well, honestly, Ryan, I can scare the hell out of you, however way you want to go running the business. I don't want to do that, but I've been told I can do that. I'm not a great guy to be around the cocktail parties and telling war stories of what's happened to clients over the years. But nevertheless, I'm here to manage the client's risk. We got a great risk management team, and I think we bring a lot of value just in that aspect alone. But there's plenty of risk to go around, unfortunately, and it continues. Then we talk about traditional insurance. I brought up the exclusions earlier. We're actually rolling out a new policy this year. I don't think you've even heard about this yet, but it's called Halo coverage. And what it's going to do, as long as you have an underlying policy, a traditional policy, the Halo is going to come in over the top. So if you have exclusions, or if you have first dollar loss, either through deductibles or co-insurance, there's co-insurances are getting triggered because there's language in the policy that triggers an additional cost out of pocket, not just the deductible, which we see that a lot now too, unfortunately. These dollars would come in and help solidify that first dollar loss. That's huge. Our exclusion. So that Halo coverage is going to be important for our business owners. I think that's something we had to come out with because, like I said, they're just going to keep adding more and more exclusions in order to offset the rate increases that they should be trying to take, but they know they can't, and they're just going to keep adding more exclusions in the back room. Your policies are going to get thicker. So I always joke, thank goodness they send those in a PDF today versus the old policies where you had to do a 3-hole punch and put it in a binder and mail it off to the client or stop by and drop it off at the client. It would just keep getting thicker and thicker at this point. But that's one of the things that we'll dive in, and we'll assess that every year too with our clients is what's new in your policies, what's excluded. And we build out a pretty good library on that based on the insurance carrier we're working with, and two, what the trends are in the marketplace.
I'm going to go back to the war stories. So instead of a war story, I want to maybe paint a picture for people of maybe your favorites or, top 2 favorite examples of how an 831B plan could work. So do you have a favorite case of helping a business out, and maybe in particular when they were initially resistant to implementing an 831B plan and saying something like, I'm never going to use this, and then they end up being saved by it?
Yeah, it happens almost every year. So I'm not in the weeds like I used to be, meaning I'm not out meeting with clients face to face like I used to. I still will, but I will tell you this. So back in the day when we first started, you could, it was a great time to start this company was in 2008. Let me tell you, it was a grind. It was a grind for the first 5 years. And during that time, unfortunately, there was a lot of tax incentive being done. As you probably are aware, the tax code's been abused, but it was abused for estate tax purposes and really to eliminate this state tax burden for clients. It was sold that way. And that's the unfortunate part. But so I kind of was fighting that in the beginning. We were risk managers first and foremost. So we wanted to, we believed what we were saying is true, that this is a great risk management tool, but we understood the business owners being highly incentivized for taxes. So yeah, we still have those clients. I get that. I get it. At the same time, yeah, these are the same clients that said, hey, I'll never use you, but the very following year, and it happened to a medical malpractice. It was SPA, actually.
Mm-hmm.
It was a brand damage claim. An incident occurred he lost a patient and made local news about it. And unfortunately, when it comes to any professional liability insurance, or in this case, medical malpractice, it's a math problem for the insurance company. It's not they're not worried about their client's reputation. They're not worried about the effects of this business long term if they settle or they don't go to court and fight the case, even though the doctor didn't do anything wrong, right? And that was basically the scenario here. And it hurt his business drastically. And, he had that war chest. It's a war chest or a rainy day fund, right? Mm-hmm. I kind of hope it's a rainy day fund. Now you have an unexpected expense and you're going to use it for that. That's best case scenario. Worst case scenario is you're at war and you got to go fight for your company. And in today's world, either you're being sued. So we have a dispute resolution policy that will protect pays for your legal defense if you're served and you got to go to war, and your general liability or your professional liability insurance isn't going to pick it up, which we've seen a lot more of those lately as well. So shockingly enough, where insurance carriers are simply aren't going to cover your legal defense, even not alone if you had a judgment against you. So we are the largest manager of these plans in the country. We currently manage over 800. We're on track at current pace to double that in the next 3 years. And what's happening, honestly, is the tax thing's kind of going away, Ryan. It's really the risk. And to your point earlier about the market that we're in today, they're just not even willing to take the chance of having a claim today. So why not take high as deductibles as you can and fund for that deductible, at utilizing tax deferred dollars. And I think there's an efficient way of doing that I think we could bring to the table that, really the conversations ever since COVID, our conversation on this thing has changed drastically.
Right.
Leading into COVID, it was cyber, it was political risk. We talked about supply chain risk. That really didn't show itself until COVID happened. And then business owners were like, well, wait a minute. I do have these are people that buy, it's like me getting that risk management by accident. People didn't, I own 3 body shops. How did you come to own? Well, I started doing body work in high school, and the owner liked me so much, he sold me the business. But he didn't go to business school. He didn't, these are people that are hardworking people, know their skill very well, but maybe rely on other people to help with business, right? And they rely heavily on their CPAs to help them with their business strategies and all of those things. And so, these people are busy. And honestly, you don't know the risk. You don't know how good your policy is until you need it. And unfortunately, when I was selling traditional insurance, I would tell you, I don't know, at least 40%, if not more of the time, I was telling business owners they're not going to be covered. And here's why. Or, hey, if you turn it in, here's what's going to happen to you. Not great conversations to have with clients, right? That's really And hey, most of these guys are entrepreneurs. I say it all the time. I'm an entrepreneur. We got to have short-term memory, right? You wouldn't get out of bed. You'd be in fetal position almost 24/7 if you remembered everything, all the trials and tribulations, as my business partner likes to say, that we had to go through to get where we are. And of course, now we're a 17-year overnight success story. We like to consider ourselves. But no, there's a lot of hard work in any business. How do you protect that? How do you manage that? It's utilizing a tool like this. And that's all it is a tool. At the right time, it's a great tool. If you're not in a position to utilize us today, I hope someday you will be, because that just tells me you're running a very successful enterprise and you're trying to hedge for the downside now. And that's where we want to catch you as a business owner.
Yep. I think the piece that owners need to realize is these risks are present in your business, like regardless of what you think about it or not. They are present, and you have a choice. You can either pay it with pre-tax or post-tax dollars. And going back to what you said with kind of the pandemic, if you're ever in that position, as a business owner, we love control. And you don't want to be in a position where you're ever having to rely upon the government and hoping that they pass a stimulus package, because you're going to hope next time that it happens and they're not going to pass it. And then you're going to have no options. With this tool, you have options. And I think that's what makes it so appealing. Now, I want to move into, we're kind of wrapping up the show, but the last thing I want to dive into is kind of the legal landscape with regards to 831B plans. So a lot of people probably just aren't aware because it's not their space, but in January, the IRS passed final regulations on micro-captives. Can you discuss the legal landscape as it comes to 831B plans and how specifically SRA administers 831B plans to be compliant with IRS requirements, and what other providers get wrong when it comes to IRS compliance?
That's a mouthful, Ryan, just so you know. If you wanted to wrap up, you just add another 30 minutes to this conversation. No, I'll keep it brief. I would tell you the regulations, it's something we've been dealing with since 2016. So we're not afraid of the 888 documents. It's a illicit transaction or transaction of interest. The illicit transaction is more serious from the eyes of the CPA community. It's almost guaranteeing you an audit. It takes 10 years of owning one of these plans before you even get into that. And those are, you still have to meet certain things before you even become a illicit transaction. We're not too worried about any of that stuff. I mean, we're just not worried about all that. Now, I will tell you, there's a good chance it's going to get quashed, those new regulations, based on the Chevron case. First and foremost, last year it turned over that these are additional regulations, a federal bureaucracy is adding to an existing law that's not written into law. I know it's being challenged all over the country, and we're actually looking at litigation ourselves with the IRS over these regulations. And if they don't if Congress doesn't come to the table and say we're going to quash these additional regulations put forth, there's an opportunity to do that when the new administration comes in. I will tell you this: when the administration left, and it doesn't matter what side of the aisle you're on when it comes to politics, a lot of administrators on the way out drop a lot of new regulations through their bureaucracies. It's one way they can get some things done that they wanted to get done at the very end, but it would maybe put too much of a political hot button to do while they're trying to get reelected. So that's kind of what happened. And again, if it happens, it happens. We're not too worried about it. We don't have anything to hide from the IRS. We've gone through our 6,700 promoter audit. What that means is if you're out promoting a tax code, and you get successful at it, and like I said, we're the largest manager of these plans, you're going to bring the attention of the IRS to you. We went through that, started that in August of 22. It closed June of 24 with no changes. I think we were one of the few, if only, managers that managed 831B plans and insurance companies to ever receive that letter. So I think that speaks bold to our program. There is a 4-part test you got to adhere to. If any place our competitors fall short on is a thing called the distribution of risk. There has to be the law of large numbers applying to your insurance company. You can't just insure 100% of your own risk, call yourself an insurance company. So there is an element of a risk there that you have to calculate. And of course, we work with our business owners on that. The other thing too is I think we stay in our lane. We don't manage the money. Mm-hmm. We don't have any interest in that. And I've got competitors that not only manage the money, but they're going to try to sell you a life insurance policy inside the captive, which we don't allow. There's some things in there that I think just rubs the IRS wrong. and is I think we'll do everything we can to stay out of that, because it's one thing to get me, okay, you got a deduction on the premium. Great. Good for you. That's what the code said you can do. Now you're putting it into the insurance company, 831B plan. It's a C Corp. You're electing to be taxed under the 831B provisions. But now what are you going to use the reserves and surplus for? And that's really where it gets a little ugly, honestly, Ryan. That's why we love working with financial planners. You guys are going to manage the reserves and the surplus of the plan. We don't do that. We don't get in your pocket for that. We don't have any interest in that. We're doing what a 401k administrator does, is minister the plan, making sure those dollars stay tax deferred, that you're adhering to. And, 401k is obviously ERISAs and, are the right retirement, or the right, are you providing the right types of investments for the plan, but they're not managing the money on behalf of the employee or the employer. And we're doing the same thing. And I think that's what makes us unique and keeps some of the heat off our clients, because we've never had a client get audited due to owning an 831B ever in, I want to say 17 years of doing this now, that we've never had that happen. And I don't think a lot of managers can say that out there in the marketplace.
And another thing SRA does really well from my perspective is you over disclose. I know you've provided, the 8886 and a couple other forms when you weren't required to. So when these regulations came into play, it's honestly, I don't think it changes really the way you even did business, because you're already doing it. The last thing I'll touch, and I do think this is important because we just live in such a age where you can get all this information from Google, and then from your tips is like, when people first discover, 831B, they're going to go ahead and Google it, and they're going to get a bunch of bad articles and PR surrounding microcaptives. But if you really apply yourself and dive deeper into it, you're going to find that a lot of these transactions were abusive because they were lacking many of the attributes of legitimate insurance. And so I think it's important for people to understand that, to have like a legitimate 831B plan, that's why that four-part test is so critical in the validity of having 100%. That plan. So Van, any last closing words? I'll put SRA's information in the show notes and description so they can learn more about what it is you do and who you are. Any last words for the...
I would say this, and I think, I know a lot going on in the vaccine right now politically. We are driving this to become a normal business practice. No different than the 401k. And we have a lot of our competitors that we're kind of in line with on that. And we're making a lot of good faith effort with Congress right now. And we're getting a lot of traction there because it's kind of replacing the PPPs and ERCs in the future. This should have been there in place already, honestly, to where we didn't. I think we still have economic fallout because of what happened during COVID. And I don't know if everything's shown itself yet for what that caused. And to your point, I don't think you can rely on government doing it the next time. So again, what are you doing differently today? So that's one thing. This will become a normal business practice. I think we're in the front of the bell curve right now. I think as a business owner, you are competing with competitors that have these things already in place. That gives them a competitive advantage. I've seen that a lot happen too. That's for another conversation. But, just remember that. If you've seen bids going out and they're a little bit lower than yours, and they're like, well, how is this possible? It's because of the way they're positioning their dollars, their tax dollars, emboldens them through innovation and risk management to take different risks in different areas that they wouldn't otherwise do. And that's efficiencies of business that I want to be bringing to those small to middle market business owners. And here's the thing. It's a tool in a toolbox. I think you owe it to yourself, the risk you took, the business you own, the employees you help support, to look at all tools available to you. And that's what you got to look at it. And you got to do your own due diligence. You got to do your own thinking and understand there is a propaganda machine out there from the IRS. That's really the only tool they have. They don't have the manpower. They don't have the knowledge. They don't have the technology, honestly, to do nothing more to intimidate taxpayers. And that's what they've done. And they do a really good job with that. They continue to cherry pick bad faith taxes. And that's what's driving the problem there. But anyway, not too worried about the IRS at this point in time. I think this is going to become a normal business practice, not out of the incentives, but more out of the risk mitigation it's going to bring business owners.
Beautiful. Well, Van, I appreciate your time and coming on the show and sharing your time and knowledge with us. Again, appreciate having you on, and that's a wrap for today. Take care.
Thank you.
Hey, real quick before you go, thanks for listening, and please remember to hit follow on your podcast player. You won't miss any episodes, and it helps support us bring you the show. Today's show notes and resources are available to you by clicking the link in the description. The opinions and views expressed here are for informational purposes only and is not tax, legal, financial, investment, or accounting advice. This material is educational in nature and should not be deemed as solicitation of any specific product or service. All investments involve risk and a potential for a loss of principal. Should you need such advice, please consult with a licensed financial, tax, or legal professional. Neither host nor guest can be held responsible for any direct or incidental loss incurred by applying any of the information offered.